Hey guys, welcome back. I'm Jeb Smith, real estate broker here in Southern California, and today I have Josh Lewis of Buywise Mortgage with me. And what we're going to do is we're going to talk a little bit about what's going on in the real estate market, but more so on the mortgage side. We're going to talk about interest rates. We're going to give you an update on interest rates, where they are now, where we expect to see them in 2021, more of a forecast. And we're going to talk about affordability, how interest rates tie into affordability, and how there's this, preconceived notion out there that, that there's less affordability in today's market because of rising prices, etc. And then lastly, we're going to talk about something that just happened, and that is conforming loan limits going up, and how with a rise in conforming loan limits and potentially lowering interest rates, how that could affect the housing market as we move forward. And if you're new to me, new to my channel, do me a favor, hit that subscribe button. So, Josh, let's take a minute here and just talk about interest rates, where we are right now. Today is the day after Thanksgiving, so Black Friday. Let's just get a briefing on where we are, and then we can talk about where we expect to be in a couple of weeks.
For all of the students of Jeb Smith videos that have been watching and taking notes on all of them, if you go back to let's see, where did we really hit the worst point? In April, when we were kind of in the middle of the first shutdown, and rates were getting better, but we were talking about why aren't rates lower? Because the 10-year Treasury had shot way down low to like 0.3, 0.4% at its lowest levels, and mortgage rates were good, but they weren't nearly as good as they should be. And one of the things we had talked about is the spread between 10-year Treasuries and mortgage-backed securities was as big as we had seen them in 15 years. Well, what we've seen is the 10-year Treasury, as the economy has improved a little bit, as we, for a while, were coming out of lockdowns, the 10 had gone up, and the 10 had gone almost up to 1%, so almost a little over a 0.5% increase, but we have not seen that in mortgage rates. We've seen rates continue through the year to get better and better and better. And that's because we finally have got back to the same spreads we had between mortgages and the 10-year Treasury that we had earlier in the year. And because of that, mortgage rates are at their best levels of the year, despite the fact that Treasury rates are double what they were earlier in the year. So what does that mean? It means that the majority of our clients on conventional loans that are refinancing are in the 2.875, 2.75 range. If you want to pay some points, you can get that easily into the 2.5 range on a conforming loan, and we'll talk what that actually means, because that just increased. We had a very well qualified borrower on an FHA last night. We did an FHA loan 2.25 with almost 3/4 of a point credits. They were buying a $450,000 condo. Not only did they not pay any points, they got $3,000 towards their closing costs. So rates on the mortgage side are spectacular right now, and that's a piece of it. But one of the things for me, a mortgage professional in a crazy COVID year, where there's not a lot to do other than work and go home and hole up with the family, that's been stressful. And what made it really stressful is coming to work when lenders were 15, 20, 30 days in underwriting, and people are wanting to get their mortgage closed, to get their payment down, and it's just dragging on. We have a lender that you've talked about throughout the year that at their worst was maybe only 4 or 5 days in underwriting. They're underwriting loans in 4 hours. My preferred lender is getting us approvals in less than 2 days. So that's not everyone across the board, but there's a handful of really well-performing lenders that we can place your loans with that we can close in a really quick time frame. So that's exciting, the fact that we're able to get the best rates without the big long waits that we had earlier in the year. So it can be a really good time of year, either to purchase if that time is right for you, or to save some money on the refinance. And the reason being with that is most people from, say, the week before Thanksgiving through the first or second week of next year, they don't want to deal with mortgages. It's the holidays, you're shut down. But this year, rates are really low. You can take advantage of it, and the big long lines that we had earlier in the year are not nearly as prevalent.
All right, so you said two things that I want to ask, and I recently read a stat, I think maybe even today, that 19.4, somewhere between 19 and 20 million people are still eligible for refinancing. So there's that many people out there that, because of where rates are, still haven't taken advantage of the market. So I guess my first question, and it might even be more than that. I don't quote me on the stat, but it was somewhere in that neighborhood. You mentioned if you wanted to buy down rates, you could end up paying some points and what have you. So, wow, can't talk. Earlier in the year, we had talked about how it really doesn't make sense to buy down rates because rates, we were predicting them to go lower, right? Everything is, we think rates can go even lower. There's a potential for them to go lower. It's silly to buy points, etc. So even, I guess let's address the first question is, does it make sense now, do you think, to buy points, or do you think there's an opportunity that rates could go even further down?
So in general, when we look at a rate sheet, and they're more normal now than they were earlier in the year, we're seeing weird anomalies where lenders were really trying to push you to a certain note rate.
Right.
But on a normal day, a lender does not care what interest rate you take. If you want a lower interest rate, it means they're going to receive less in interest over the life of the loan. They say, fine, pay me a lump sum up front to offset what I'm going to make over the long haul, and I'll be fine with that. And that generally amounts to 1% up front. So say a $300,000 loan, $3,000 will lower your interest rate 0.25%. It puts your break even out a little bit farther than 4 years. So for most people, it doesn't make sense to do that because you want to retain the flexibility. Once you pay that point, it's a sunk cost. You have to be there longer than 4 years just to break even. That doesn't take into account that interest is generally tax deductible for most borrowers, so that pushes out the break even another year, year and a half, 2 years. And we are in a 40-year bull market in interest rates. You go all the way back to 1982. It obviously has not been a straight line down in the last 38 years, but with stutters and starts in different directions, it's been a decrease in interest rates. So every 3 to 5 years for the last 38 years, which is basically almost all of our adult lives, except for baby boomers and above, we've had an opportunity to refinance. So your best bet is do something as close to no cost as possible. Keep your loan as small as possible. What I hate seeing is I have people who will come to me and they'll have refinanced 3 times in the last 10 years. And they've paid a point every time, and they never paid their loan down. Every loan is roughly the same as the last one.
Right.
So it's great, you saved money on your monthly payment, but one of our purposes with home ownership, if it's your primary residence, is we want to get that loan paid off over time. You're trying to arrive at retirement either with a big lump sum. We see a lot of Californians where we are, their home is appreciated a bunch, they get it paid off or close to paid off, they take that money and buy a cheaper home somewhere else in the country.
Right.
Or you build up that equity, you can get a reverse mortgage, use that as income. One way or the other, you want to be building up an asset, just like you want to be saving for retirement with your 401k, you get a little bit of Social Security, you have your house paid off. So for all of those reasons, the long bull run in interest rates that we have not seen end yet, and until it does, I just don't think the small benefit, when people see how little they save with that additional 0.25% decrease in rates, most people would prefer not to. And what's interesting is ask someone, 2-3 years ago that paid an extra point to get the world's lowest rate. They're going to tell you, no, I wish I hadn't done it.
Well, yeah, and I guess the only reason I even bring this up is because if you listen to the radio or you watch TV, everything is talking about these rates at 1.99% or 1.75% for a 15 or whatever the rate is. And what people don't understand is that those cost points to get there. So, keep that in mind when listening to the radio, watching TV, that, there's more to it than just that rate. But, we'll talk about that in more detail on our next live when we do something where we can answer people's questions. In order to keep the video short, I kind of want to move along. Affordability. What are we seeing with regards to affordability, right? So there's everything out there that's saying that, because of where home prices are going, affordability is now an issue. And long term, it's going to be an issue. It's becoming, because essentially what we're doing is home values are moving up a lot faster than incomes, right? In a lot of areas. But there's another way to look at that. So what is your take on affordability at the moment?
Well, let's talk about what affordability actually means. As a measure, it is a measure of what proportion of people with the median income can afford the median priced home. So there's 2 pieces that go into it. What's happening with wage growth? So are people making the same amount of money? Is it going up? Is it decreasing? And then what's happening with interest rates? So what does that payment amount to? Because in the real world, people do not care what the price tag is on the home. They care what the monthly payment is. You've all seen that, at this time of year with the Lexus holiday event. They're not advertising, hey, you can get a Lexus for $53,000. They're saying for $399 a month, you can lease this car. Not a smart way of looking at it with cars, but it is in the real world how people do it with housing. So over the last year, we're going to get into next that the conforming loan limits are increasing for 2021, and the amount they're going to increase is 7.5%, and that's based off the FHFA's home price index for the last year. It says home prices have gone up 7.5%. So when people hear that, they go, "Oh my God, homes were expensive. They're now 7.5% more expensive." Well, over the last year, interest rates are also down a full percent. So in terms of affordability, the same amount of people that could afford a median priced home last year can afford it this year. So it doesn't mean, can I afford it, or does it sound reasonable? It's just a measure of what's happening over time. Can more or less people afford the median priced home? So it makes for great headlines. Just like when you turn on the news at night, all they do is tell you more people than ever have got COVID. It's the blaring headline that gets people to look. Oh, home affordability reaches an all-time low. Well, does it really? Home prices have reached an all-time high, but that doesn't mean affordability is an all-time low. We have a lot of people, because of the pandemic, that are out of work, but the majority of people that are homeowners or at the higher wage end of the wage scale haven't lost jobs, and they've still seen wage growth. So wages have gone up, interest rates have gone down. So yes, home prices have gone up, but affordability is about the same level as it was last year. It's actually a tiny bit worse. But if we really wanted to dig into it and show you the charts, it truly is just a tiny bit less affordable than it was a year ago in terms of how much of your household income has to go towards that monthly payment. So when you're watching the news and you see these crazy headlines that, oh my God, no one can afford homes, what are we going to do? Nothing's changed. There's a reason why home prices go up. And it's not that the market is insane or people want to pay more for homes. It's that the same percentage of people can afford those homes, and they're fighting over a limited supply. So when we look going forward, what's likely to happen? I still believe rates are going to go lower. They may not go straight line lower. We could go up 0.5% for a year or two before we go down and see where someday we have a 2.5% 30-year fixed. But we will have a 2.5 or a 2.25 30-year fixed at some time in the next 5 years. So that will lead to home prices going higher. Wages for most people are going to continue to go up. Most people who can buy a home and afford a home are going to continue going up. On top of that, we have a massive lack of supply. It is hard to get building permits to build enough homes. And we also go back 33 years ago, we had the biggest growth spurt in population since the baby boom. 33, 32 years of age is about when people start forming households and buying their first home. It used to be lower, now it's higher. But you have a large amount of demand, a limited amount of supply, interest rates low and continuing to trend lower. This is not going to turn around. I know there's people, Jeb, you have a lot of followers on your YouTube channel, and if you check into YouTube and you look at housing videos, you see these crazy, stupid headlines of, why hasn't the housing market bust yet? When is the bubble going to burst? The answer is no time soon. I'm not saying they're going to the moon or they're going to double from here, but we're not going to see this go down anytime soon, because simple math and understanding of economics tells you limited supply, plenty of demand, and demand likely to stay high because affordability is going to be reasonable, not good, not great, but reasonable. Home prices are going to continue to go up.
Right. No, and while we're talking about irrational headlines at the moment, one you'll see out there at the moment, because you just brought this up, says that mortgage delinquencies are at an all-time high. 21% of mortgages or something are in default. But if you go and read the fine print at the bottom, they're taking all of those people that filed for forbearance or in forbearance and haven't made their payment because they're in forbearance and allowed to miss their payments. They're counting those as people that are in default. It makes no sense at all. I mean, it's a headline, right? It's meant to grab attention, just like the majority of people out there with the doom and gloom and all that. But that's a whole nother video that's not worth getting into at the moment.
Well, Jeb, you remember what do they say? They teach you in journalism school: if it bleeds, it leads.
Right.
So anything that they can make a sensational headline out of is you're gonna lead the news. It doesn't mean it's accurate. And unfortunately, a lot of people, if you are not a homeowner right now and you're wanting to get into the market, you would obviously hope for home prices to come down. You don't want the things to happen that would have to happen for home prices to come down, but you would obviously like to buy in at a lower level. So we have this weird sense of non-owners that want to own are hopeful for it, and there's people pandering to it with these crazy headlines telling them it's going to happen. I'm more than willing to make a video with anyone, no matter how big their YouTube channel is, and debate the numbers and tell them, let's come back in 3 years and see who's right. I'll bet you almost any amount of money, home prices will be higher 3 years from now than where they are today.
No, and I think that's fair. So, hey, comment below if you guys want to challenge. So, lastly, let's talk about conforming loan limits. So here in Orange County, we're one of the most expensive areas to own in the country. So, we have different I'll let you talk about conforming loan limits here in a second and how they're adjusted in different areas. But what are the new conforming loan limits, if you know them off the top of your head? And how will that impact areas like we're in, Southern California, where home prices are much past what Fannie and Freddie are normally lending on conforming loan limits?
So last year for 2020, the conforming limit increased about 5.5% up to 510, 400.
Right.
The announcement this morning was an increase of 7.5%, and they based that off of how much the FHFA home price index went up over the last 12 months. It's not a perfect index, but it's a good measure of nationwide what happened with values. It puts us at 548,250 for this year. So anywhere in the United States, you can get a loan for $548,250 or less, and it fits within Fannie Mae, Freddie Mac guidelines. Now, in high cost areas, you can get up to 150% of that. So it doesn't mean that it's every high cost area. Some high cost areas, maybe the number is only 600, maybe it's 650. But in true high cost areas, Orange and LA County, the Bay Area, New York City, we're looking at a full 150%, will put us to 822,375. It's a big number. It's a big number. You're buying with 20% down, you're up at $1,050,000, $1,075,000, somewhere in that range as a purchase price with 20% down. It also allows you to do with a 5 or a 10% down, a combination loan of a first and a second, and go to that same level, the $1,050,000, $1.1 million. Really it's not really a negative spin to it, but on some jumbo programs that are interesting or unique, they require you to be above the conforming limit, so above that 548,250 loan amount, before they will allow you to go on some of the non-conforming programs. So it can mean some people are not eligible for those, but it's not a big deal for the most part. For us in Orange County, a lot of the stuff is still going to be jumbo. As crazy as it sounds, we got a lot of 1.2, 1.5, 1.8, $2 million purchases. And they're still going to be well above the 822 number that we have. But for most people, and especially for refinances, it's a great number. So you were talking about 20 million people being refinance eligible. That's using incredibly strict numbers, or a calculation of who should be eligible. When you loosen it up just a little bit to include most people, it's really close to 40 million Americans should be refinancing. And this news today will increase that number from the standpoint of everyone that took out a loan last year in that 520, 530, 540 range, or even 550 and paid it down a little bit. They can go from high balance down to a standard balance, which is about 1/8% better. Plus rates just have dropped over the course of the year. So never a bad idea to check with a trusted mortgage professional. Notice I didn't say a call center, but check with a trusted mortgage professional that can run the numbers, help you analyze them, see what your options are. Because even if there's nothing there to be done today, we keep a watch list for all our clients. We check in quarterly and shoot out numbers and just say, hey, didn't make sense for you, in December of 2020, but maybe in May of 2021 or December of 2021, it does. And you have someone keeping an eye on that for you.
No, for sure. And if you're one of those people out there that's even thinking about refinancing, whether it's in California or not, and you don't have that trusted professional, reach out to me. I'm happy to put you in touch with somebody that either I know directly or Josh networks with. We're both, in that relational style business and work with a lot of top professionals in different areas. And we, put you in good hands, somebody that can take care of you. So, and we've done a lot of that. A lot of you guys have reached out, and I'm constantly referring or either, asking Josh for a source in some of these areas. And keep in mind, because of RESPA guidelines and what have you, we don't get anything from. I get nothing other than the satisfaction of knowing that you're taken care of. and because I appreciate your support and you guys continuing to support the channel. So, if you want to contact Josh, what I'll do is I'll put his information below. But Josh, if you want to throw it up there on the screen, any final parting words that you want to touch on today?
No,
Let you go?
that's it. It's a good time of year. We're all, as work slows down, you're going to be holed up even more at home with stay-at-home orders. Not a bad idea to take a look at it. Most of if you refinanced 4 months ago at 3%, you're probably in a good spot. But if you're at 3.25 and above, probably worth taking a look at seeing what your options are.
And guys, it doesn't cost you anything, right? This is a no-cost thing. It's you have a conversation, and if it works, great. If it doesn't work, you move on. Nothing lost here by having a conversation, but a lot to be gained.
Yeah, so. And then the numbers don't lie. It's just a matter of putting it down on paper, and it'll make sense for you or it won't.
Cool. Well, as always, guys, I appreciate you taking the time to watch. If you enjoyed this, you're still around, do me a favor, hit that like button, and we'll see you again soon.